Let's look at Oracle. This is its forecast. A $1,000 investment in Oracle itself. Some deep models suggest it makes nearly $0 in profit over 10 years. Just barely grows. So the question is, why? The AI hype suggests a massive run, but the data says your $1,000 could return just a few dollars. Meanwhile, the market giants, the QQQ and S&P 500 project, 3 to 5 times your money. Is Oracle's current surge real? Or is it just hype against a flat reality? We're finding out now. One day, one stock. Today, we'll look into Oracle. Welcome to StockSnack. All kind of financial numbers could be overwhelming. At StockSnack, we help to analyze stock, if they are good or bad. At StockSnack, we help justify it and present it to you. Fast and joy, like having snack. Okay, today we are breaking things down, just into 4 simple parts. First up, qualitative analysis. We just need the basics. Who is this company? What are they selling? Who buys it? And who are their main rivals? We need the context. Segment 2. Then we move to the business segments. We look at the revenue. What is their main moneymaker? Which part is growing the fastest? We find the true engine of the business. Segment 3. Third, we get the financial checklist. We look at the books. Is the company actually healthy? Do they have too much debt? Can they afford to grow? It's all about the financial safety. Segment 4. Finally, the price projection. We take all that data and we ask one big question. Is the stock a bargain right now? Or is it way too expensive? That is the entire plan. Simple, clear. Let's start. Okay, so who is Oracle? A tech titan. It all started back in 1977 in Santa Clara, California. Classic Silicon Valley. They started as a simple software lab, but their first product changed everything. It was the first commercial SQL database. It defined modern data. Their business? It is purely business to business, selling to massive enterprises. And governments, their module is simple, subscriptions. Cloud services, database software, hardware, full package. The top earner. Cloud services and license support. That is over 3/4 of the revenue. We hit a key point in 2010. They acquired Sun Microsystems. This acquisition brought 2 crucial assets. 1. The Java programming language. 2. They got into hardware selling servers. Then the big pivot came, 2013. They released the Oracle 12c database. The C meant cloud. This fully committed them to infrastructure. Now, let's look at the rivals. This is critical. The entire industry is technology. Enterprise cloud. Oracle is playing among giants. And Microsoft is the biggest. They are the #1 competitor. Microsoft has Azure Cloud. That's their Oracle Cloud Infrastructure rival. They have Dynamics 365. That fights Oracle's Enterprise Resource Planning, ERP. It's a direct full-stack battle. Then you have Amazon Web Services, AWS. They are the cloud market leader in terms of sheer size. A pure infrastructure play. Compute, storage. And Google Cloud, of course, is right there too. They bring the sheer scale of Alphabet. Now, let's look at the enterprise software specialists. You have SAP. They are the historical rival in enterprise resource planning. ERP, they basically run the back end of global manufacturing. And then there is Salesforce. They dominate CRM customer relationship management. They fight Oracle's CX cloud apps. Finally, there is IBM, the old guard. They focus on hybrid cloud and consulting, a full-service approach. So Oracle is in a war, a database war, a cloud war, an application war. Now the qualitative final thoughts. The business frontier is clear. It's an aggressive expansion of Oracle Cloud infrastructure. They are chasing the multi-cloud market, building AI data centers. This whole thing is driven by Larry Ellison's vision. He is the veteran leadership. His mandate is clear: become the dominant AI cloud infrastructure provider. That is the future direction. Building those massive data centers, and the competitive advantage is unique. They are the only one with the deepest database core. They integrate that autonomous database directly into every cloud and every application. So, the industry trend is a massive AI-driven surge. Oracle is right in the middle of it. That's the news story. The shift is complete. Okay, Let's look inside Oracle's vault. This is the business segment analysis. It tells a clear story, a massive pivot. The most important segment is cloud services and license support. In 2019, it made $26.707 billion. By 2025, it hit $44.03 billion. That is a compound annual growth rate of 10.5%. It's massive. It's the subscription engine. But look at the rest. The legacy pieces, the old-school cloud license and on-premise license, that revenue is shrinking. It has a CAGR of negative 2.3%. It is the old business model fading away. Same with hardware. The servers and storage, it's down at a negative 4% growth rate. So what does this mean? It means Oracle is dismantling the old self. They are successfully abandoning the traditional license sale and replacing it with the high-growth cloud subscription. The growth is real, but it is concentrated in one place. The cloud is the only thing that matters now. We now look at operating income. This tells us about profit health. Our financial floor is the benchmark. It is defined as 2 times the inflation rate. The cloud segment is incredibly strong. Its compound annual growth rate is 8.7%. This is significantly above benchmark. It shows excellent health. In fact, 91.8% of all profit comes from that cloud business, a massive concentration. But the other segments lag. Look at hardware. Its growth is only 1.7%. This is below benchmark. It's shrinking. Same for services. Only 4.7% growth. Also below benchmark, so the profit story is clear. The cloud is the only profitable engine driving the company. Everything else is either flat or shrinking in importance. Finally, the price projection. This is the big comparison, 10 years out. We start in 2025. We look at 2035. If you put $1,000 into the market, like the S&P 500 ETF benchmark, you could expect to earn $3,287. That is a 3.3 times return. Now, look at Oracle itself. The internal math. The most conservative models are clear. One projection suggests a gain of only $33. Another suggests a loss of $111. The average conservative model shows your $1,000 earning a net negative $1. So, the growth is not guaranteed. The spike is based on the AI contracts, and not its historical financial math. The market is pricing in a 5x return. While the internal numbers predict 0 return, that is the entire risk, the ultimate question. Now, we're looking at the financial health checklist. We are assessing Oracle's risk. We've gone through 3 main statements in the annual reports, namely the balance sheet, the income statement, and the cash flow statement. Each, we analyze multiple metrics to access if it is healthy. This will be discussed later. Right now, we will provide an overview to get a top-line insight first before deep diving. So, let's look at the latest scores. Our benchmark for healthy is a 70% good score. The balance sheet scored 50%. That's bad. The income statement scored 62.5%. That's bad. The cash flow statement also hit 50%. That's bad. The results are clear. Oracle fails the latest health check. We are checking the balance sheet. This is the financial health report. First, cash to debt. The benchmark is 1.0. Cash should cover all debt. Oracle's latest number is 0.21. That's bad. Their ability to instantly cover debt is low. Next, debt to equity. The benchmark is less than 80%. They should finance with equity. Oracle's ratio is 509%. That is bad. They rely heavily on debt, very highly leveraged. Now, a very bad sign. Retained earnings growth, their CAGR, is negative 195%. That is a serious inability to grow cash reserves. That's bad, but there are bright spots. The return on equity ROE is 61%. The benchmark is 25%. That's good. They are still generating high profits from the equity they have. And return on total assets ROTA is 12%. The benchmark is 10%. This is good. They use their assets very efficiently. So, a mixed report. They are highly profitable with the assets they own, but they are extremely leveraged and burning cash. We are checking the income statement metrics. This shows the quality of their earnings. First, The good news, pricing power is strong. Their gross profit to revenue is 71%. The benchmark is 40%. This is good, high pricing power. And the cost of selling is low. Selling costs are only 25% of their gross profit. That's good. Now for the danger zone. Debt. The interest they pay is too high. The benchmark says interest should be less than 15% of operating income. Oracle's is 20%. That is bad. Their debt load is eating earnings, and that debt gives us a bad flag on the payback period. The debt to EBITDA ratio is 4.35. The benchmark is less than 3. Their debt takes too long to pay back. Finally, their tax rate. Their effective tax rate is only 12%. The benchmark is around 20%. This low rate is a credibility flag. That's bad. The takeaway is great business quality, but financing it is expensive and risky. Now, the final segment of the financial health check. We look at the cash flow statement. The real money moves. First, shareholder dilution. Stock compensation is only 8.14% of revenue. That is good. The benchmark here is less than 30%. They are not heavily diluting shareholders. But the quality of earnings is a huge red flag. Operating cash flow divided by net income is only 0.6. That's bad. Cash flow should be higher than reported profit. That's the rule. This suggests their reported earnings are not backed by real cash. The cause is simple: high cash outflow. Look at CapEx versus net income. CapEx is 170.5% of net income. That is bad. They are spending almost 2 times their annual profit just building data centers. This spending causes the next problem. Their free cash flow growth is severely negative. That's bad. The cash flow is being drained by the AI infrastructure build. It all points to the same conclusion. Oracle has a massive growth plan, and they are paying for it with cash flow sacrifice. The company is financially stretched to fuel this AI future. We reach the final conclusion. First, the financial health report. The benchmark for overall health is a 70% good score. Oracle fails every single statement check. The balance sheet failed. The income statement failed. The cash flow statement failed. Look at the 5 key attributes. They are all bad. The debt to EBITDA ratio is over 400%. The benchmark is 300%. Free cash flow is negative 10.6%, a serious cash drain. The company is financially stretched to fund its AI future. Now, the price projection. This is the ultimate risk. The S&P 500 predicts a 3 to 5 times return, but Oracle's own math, on average, suggests a $0 gain in 10 years. The current stock price surge is based on pure hype. It is betting that Oracle's massive risk pays off. The reward is high, but the current financial risk is undeniable.